Ladies and gentlemen, if you think you understand the risks facing the global financial system, think again, because what's about to happen with silver, I'm telling you right now, it could rewrite the fortunes of anyone who owns precious metals and devastate those who don't. This is not fear mongering, this is reality. And if you own gold or silver, you absolutely need to hear what I'm about to tell you. For years now, silver has been sitting quietly in the corner of the financial markets, ignored, underestimated, and misunderstood. While investors have been distracted by soaring stock prices, speculative bubbles, and the illusion of prosperity created by cheap money, silver has been building one of the most compelling setups for a major upside move that we've seen in decades. And the irony is that the very forces investors are relying on to protect their wealth are the same forces that are going to destroy it, while silver stands ready to benefit. To understand why silver is positioned for such a dramatic move higher, first need to understand how distorted the current financial system really is. We are living in a world where debt is no longer seen as a problem, where deficits are celebrated, and where central banks believe they can create prosperity by printing money. This experiment has never worked in the past, and it won't work this time either. But set neither. Every time, governments have chosen the easy path of debasing their currency instead of making hard economic choices. The result has been the same: inflation, loss of purchasing power, and a return to real money. Silver is real money. It has been for thousands of years, long before there were central banks, long before there were fiat currency backed by nothing but political promises. Silver functioned as a store of value and a medium of exchange. The only reason it doesn't play that role openly today is because governments don't want competition for their paper currencies, but suppressing silver's monetary role hasn't eliminated its value. It has merely delayed its repricing. One of the most important reasons silver is poised for a major upside move is its extreme undervaluation relative to gold. Historically, the gold to silver ratio hovered around levels that reflected their natural abundance and monetary use. Today, that ratio is wildly out of balance. Silver is far cheaper than it should be, not because it lacks value, but because the market has been distorted by paper trading, speculation, and a general lack of understanding. When that ratio eventually moves back toward historical norms, and it always does, silver doesn't just rise, it accelerates. But silver's story doesn't end with its monetary role. Unlike gold, silver is also a critical industrial metal. It's used in electronics, medical devices, solar panels, and a growing list of technologies that modern economies depend on. This creates a unique situation where silver benefits from both monetary demand and industrial demand. As governments push for green energy transitions and electrification, silver consumption continues to rise. Yet silver isn't endlessly recycled the way gold is. Much of it is used up and lost forever. That creates a supply problem that the market is not yet fully priced in. At the same time, the supply side of silver is far more fragile than most investors realize. Silver is often mined as a byproduct of other metals, which means production doesn't respond quickly to rising prices. Even if silver demand surges, miners can't simply flip a switch and increase supply. That imbalance between supply and demand is a recipe for explosive price movements. Once the market wakes up, and wake up it will, because inflation is no longer theoretical. It's not something economists debate on television. It's something people feel every time they go to the grocery store, pay rent, or fill up their gas tank. Official inflation numbers understate the real problem, but anyone living in the real world knows their purchasing power is shrinking. This is the unavoidable consequence of years of monetary irresponsibility. When inflation becomes undeniable, investors look for assets that can't be printed. Stocks may appear to rise, but in real terms, they often fail to keep up with the loss of purchasing power. What's the loss of purchasing power? Bonds are guaranteed loss when interest rates don't compensate for inflation. Cash is the worst option of all. Silver, on the other hand, doesn't depend on earnings projections or government policy. Value exists independently of the financial system. Another factor that makes silver's upside potential so powerful is its relatively small market size. It doesn't take a massive shift in investment demand to move the price dramatically. When even a small percentage of investors decide to allocate to physical silver, the impact can be outsized. If we've seen this before, silver doesn't move slowly and politely. Now, when it moves, it tends to do so violently, catching the majority of investors completely off guard. What's particularly dangerous for those ignoring silver is the false sense of security created by rising asset prices. Many people believe that as long as their portfolio is going up in nominal terms, they're doing fine, but nominal gains don't matter if the currency those gains are measured in is losing value. This is how wealth is destroyed quietly without people realizing it until it's too late. Silver doesn't protect you from volatility, it protects you from deception. The current setup is also shaped by psychology. Silver has been written off as a disappointment because it hasn't kept pace with specula. To assets fueled by easy money, that kind of sentiment usually marks the end of a cycle, not the beginning. Markets tend to punish complacency and reward patience. When expectations are low and fundamentals are strong, the upside risk far outweighs the downside to then sink. Eventually, confidence in paper assets will crack. It always does. When that happens, investors don't gradually tiptoe into precious metals. They rush in silver because of its affordability and scarcity, becomes one of the primary beneficiaries of that shift. By the time the headlines start talking about silver, the easy gains will already be gone. The real question isn't whether silver has value. The question is how long the market can continue pretending it doesn't. History suggests not much longer. Every cycle of monetary excess ends the same way, and every time real assets reassert themselves, silver's setup today reflects years of suppression, neglect, and misunderstanding, conditions that don't last forever. When the repricing comes, it won't be subtle. It will be swift, it will be dramatic, and it will leave behind those who believe paper promises over tangible value. Silver isn't just an investment opportunity, it's a reality check, and the longer it's ignored, the bigger the move when reality finally sets in. For decades, monetary policy has been sold to the public as a precise science guided by experts who supposedly understand how to fine-tune the economy. In reality, it has become a reckless experiment built on denial, short-term thinking, and political convenience. The inflation risk we're facing today is not an accident, and it's not temporary. It is the inevitable outcome of policies that prioritize debt, stimulus, and artificial growth over real savings, real production, and sound money. Central banks want you to believe inflation is something they can control at will, like a thermostat. They can simply turn up or down, but that illusion only works as long as people trust the currency. Once that trust begins to erode, inflation stops being a policy variable and starts becoming a self-reinforcing problem, and that's exactly where we are right now. Years of near-zero interest rates and massive money creation have distorted every corner of the economy, from housing to stocks to consumer behavior. What we're seeing now is not a sudden flare-up, but the delayed reaction to a long period of monetary excess. The fundamental problem is that modern monetary policy treats debt as a solution rather than a symptom. Instead of allowing recessions to clear malinvestment and reward savings, central banks intervene to prevent pain at all costs. Every downturn is met with lower rates, more liquidity, and bigger balance sheets. This approach doesn't eliminate economic cycles, it amplifies them. It replaces short-term discomfort with long-term instability. And inflation is the price society pays for that trade-off. When central banks expand the money supply faster than the economy's ability to produce real goods and services, the value of money falls. That's not theory, it's arithmetic. You don't need a PhD to understand that creating more units of currency in productivity reduces purchasing power, But policymakers continue to act surprised when prices rise as if inflation appeared out of nowhere rather than emergent from their own decisions. What makes the current situation especially dangerous is the scale. The amount of money created over the past several years dwarfs anything seen in prior cycles. Governments ran massive deficits and central banks eagerly monetized them. This wasn't temporary emergency action, it became standard operating procedure. Once markets and governments get used to cheap money, reversing course becomes politica, lie and economically painful. That's why central banks are trapped. If they raise interest rates aggressively to fight inflation, they risk collapsing asset markets, bankrupting over-leveraged governments, and triggering a deep recession. If they keep rates low, inflation accelerates and purchasing power erodes even faster. There is no painless exit. Every option involves consequences, and inflation is the path of least resistance. It's the silent tax that doesn't require a vote, and it's the one policymakers return to every time. Meanwhile, official inflation statistics fail to capture the real impact on everyday life. Said inflation is often ignored while rising costs of essentials are downplayed. But people don't live in spreadsheets. They live in the real economy. They notice when rent doubles, when groceries cost more each month, and when wages fail to keep up is how inflation undermines social stability, not just economic stability. It widens the gap between those who own assets and those who live paycheck to paycheck. Another dangerous misconception is the idea that inflation can be tamed without consequences. Even if price increases slow temporarily, the damage has already been done. Inflation doesn't just raise prices, it changes behavior. It discourages saving and encourages speculation. It rewards debtors and punishes responsible savers. Over time, it erodes the moral foundation of the economy by replacing long-term planning with short-term survival. The biggest victims of inflation are those who trust the system the most. Rallies on fixed incomes, workers with stagnant wages, and savers who did everything right are the ones who lose the most. They are told to hold cash, buy bonds, and trust policymakers, and then they watch their purchasing power evaporate. This is not a flaw in the system. It is the system working exactly as designed. Inflation. Risk is also underestimated because many people still believe central banks will eventually get serious restored discipline, but discipline requires pain, and pain is politically unacceptable. Governments depend on cheap borrowing. Financial markets depend on easy liquidity. Entire economic models are built on the assumption that money will remain abundant and cheap. The moment that assumption is challenged, the system begins to shake. This is why inflation is not just a short-term risk, but a structural one. It's embedded in the incentives. As long as policymakers are rewarded for growth today and consequences are pushed into the future, inflation will remain the preferred solution. The currency becomes weaker not because of one bad decision, but because of thousands of small ones made over time. In this environment, holding assets that depend entirely on monetary credibility is a gamble. Paper wealth can disappear far faster than it's created. When confidence breaks, it doesn't fade slowly, it snaps. History is full of examples where people believed inflation was under control right up until the moment it wasn't. By the time the danger became obvious, protection was no longer affordable. Inflation risk is not something to debate, it's something to prepare for. You don't wait for a fire to engulf your house before buying insurance. Yet that's exactly how most people treat inflation. They react only after the damage is done. Monetary policy has already set the stage. Excess liquidity, the debt, the distortions, they're all in place. The only uncertainty is timing, not direction. At its core, inflation is a crisis of trust. When money no longer holds its value, people seek alternatives that do. They look for assets that exist outside the promises of governments and central banks. This shift doesn't happen gradually, and it doesn't require everyone to wake up at once. It only takes enough people losing confidence for the system to feel the strain. The real danger is complacency. As long as inflation is explained away, minimized, or blamed on temporary factors, people delay protecting themselves, but inflation doesn't wait for permission. It compounds quietly, relentlessly, until the loss becomes impossible to ignore. By then, the opportunity to act cheaply is gone. Monetary policy has painted itself into a corner, and inflation is the inevitable consequence of that reality. Anyone paying attention can see it. The only question left is who prepares in advance and who learns the lesson the hard way. What makes silver so unique and so widely misunderstood that it doesn't fit neatly into a single category? It's not just a precious metal, and it's not just an industrial commodity. It sits at the intersection of both worlds, and that dual role is precisely why its long-term value is so often mispriced. Most investors look at silver through only one lens at a time, and by doing so, they miss the bigger picture that's quietly forming beneath the surface. On the industrial side, silver is indispensable. It's not a luxury input or replaceable material. It's a critical component in modern technology. Its conductivity, reflectivity, and antimicrobial properties make it essential in electronics, medical applications, renewable energy, and a wide range of advanced manufacturing processes. As economies become more digitized and more electrified, silver consumption doesn't shrink, it expands. This is not a speculative trend, it's a structural one. Consider the push toward green energy and electrification. Solar panels rely heavily on silver. Electric vehicles use more silver than traditional internal combustion engines. Infrastructure upgrades, smart grids, and energy storage all require silver in quantities that continue to grow. These industries aren't shrinking or stabilizing, accelerating, often backed by government mandates and subsidies. That means demand for silver isn't just cyclical, being locked in by long-term policy decisions. At the same time, industrial users don't buy silver because it's cheap or expensive. They buy it because they need it. That makes demand relatively inelastic. Even if prices rise, production doesn't suddenly stop and manufacturers absorb higher costs or pass them along. Silver is a small but essential part of the final product. The dynamic puts a natural